Hey guys, Ryan Dossey here. In today's video, we're going to be talking about the Brrrr method, what it is, what that stands for, and how at 26 years old, I've used it to close on over $8 million worth of assets in just the past 2 years. Let's dive right in. So as a quick overview, the Brrrr method stands for buy, rehab, rent, refinance, repeat. So the theory with it is it's almost like this no money down approach where you can take the same amount of cash and cycle it over and over and over and over again. So I'm going to walk you through the letters and kind of a couple things to watch out for on them, as well as just kind of diving into the strategy a little bit more because it's something that we've done a lot of. So the first letter stands for buy, right? So this is the purchase or the acquisition. All of the parts of the Brrrr method are extremely important, but I think the number one rule in real estate investing is it all starts with a good deal. So what do we mean by that? So in a previous video, I talked about the 75% rule. It's kind of a quick, very popular litmus test that investors use to determine whether or not something makes sense to purchase. Now, the 75% rule doesn't really work for the Brrrr method. Reason being, it accounts for your purchase, it accounts for your equity cushion, and it accounts for your repairs. But what it leaves out is holding costs as well as any overages. Back in 2018, we realized we were using the 75% rule, but we were ending up into our deals for a little bit more than 75% because we weren't accounting for our holding costs, our taxes, our insurance, our marketing, right? So what we ended up doing was budgeting in an additional $5,000 to cover our holding costs while the property was vacant, as well as recoup some of our marketing. Had we not started doing that in 2018, it would have cost us almost $100,000 in just sunk equity on our Brrrr deals. So when you're purchasing, make sure you're getting a really good deal. And this is hard for investors that aren't sourcing their own deals. Maybe you're on the MLS, you're dealing with wholesalers. The problem you're going to run into using the Brrrr method if you're not generating your own leads is that wholesalers and on the MLS, they're able to sell deals for more than 75% of what they're worth, minus repairs, minus what you hope to make. So this is a little bit like a needle in the haystack. It's one of the big reasons I'm an advocate of finding your own deals. That's actually a main focal point of this whole channel, is how I find all of my deals. Of the past 150 units we've bought for our portfolio, maybe 7 or 8 came off of the MLS or from wholesalers. The rest, we negotiated direct to seller, paying only what it made sense for us to pay, not what the bidding war got heated up to or anything like that. So moving on, assuming you've gotten the B right, the purchase, the buy correct, it's now time to talk about the renovation. Now, the renovation is basically managing either a general contractor or subbing out the project yourself. We're going to do a little bit more of a deep dive on the renovation piece. The one thing I would caution you is make sure you get a full-blown inspection done and that you really understand what kind of work needs to go into the property. Get multiple bids, don't take the cheapest one. I have yet to meet an investor who has a problem with underestimating repair costs. This is one of the number one places we see the Brrrr method go sideways. So when you're doing your rehab, make sure you're building in contingency, you're getting multiple quotes and bids. If you have 5 or 6 bids and one guy's $20,000 less, that is not your rehab cost, right? So make sure that you are using wisdom when you are estimating out your repair costs as well as who you're hiring as a contractor. It's one of the fastest ways for a Brrrr deal to go upside down. The next letter in the Brrrr formula is R, which stands for rehab or renovation. Now, I'm gonna do more of a deep dive on just this particular topic because I think it's one of the places most investors mess up. I've yet to meet a single investor who has a problem with underestimating repair costs. For the love of all that's holy, make sure you're getting full-blown inspections done to make sure you're getting accurate quotes, whether you're GCing the project yourself, subbing it all out, managing it, or if you're bringing in a general contractor to do the work, make sure you're getting multiple bids. A little bit of a pro tip: if 5 or 6 of them are like $50,000, $60,000 and one guy comes in 20,000 below at 30, your repair cost isn't going to be 30,000. It's typically going to be about the average of what you're seeing. Always make sure you're doing things like checking references, making sure they're licensed, bonded, insured, collecting W-9s before you pay them. The second part is R for renovation. It's typically where we see these deals go sideways, because unexpected things come up as you start to open up walls, move stuff around. So make sure during your due diligence phase, you really understand the scope of what it is that you're getting into, because this is where it can get a little bit messy. The R in the Brrrr formula stands for renting, right? You have to get the property rented out, cash flow coming in to, start to make money as an investor. Now, this is where I want to caution you about following some of the conventional wisdom, some of kind of the typical rules. Deals at like the 1% rule, for instance, really aren't going to cash flow. So make sure that you are getting a good enough rent to cost ratio. Even 1.25 may not be enough. Now, if you're in a more expensive market, I realize this is kind of like, I'm not going to find anything that is like that. It's kind of a balancing act. So my goal, I'm always looking to purchase properties that pay for themselves, they cash flow, right? I'm not doing any appreciation, any speculative, it's only going to bleed $100 a month. All of our properties are cash flow positive properties on their own. However, we are purchasing in areas that we believe are likely to appreciate. Right? You don't want to buy in areas that are just flat, because then you miss out on the trend of upward price mobility. So for us, we're typically looking at like C+ to A- asset class areas. And on the renting side, this is going to be a little bit of an easier pool to manage. Now, in my personal experience, kind of the lower you go down in asset class, the more management intensive things become. On my A-class single families we don't really run into things like, police calls, bed bugs, evictions as often, that kind of drama that tends to happen in the lower priced units. So, if you're looking for mailbox money, this isn't passive, right? It's going to be work, whether it's for you, for somebody else, for a property manager, an employee, whatever. But typically, the nicer your properties are and the better areas they are, the less headaches they're going to be. When we're leasing a property out, our typical criteria for the tenant is no evictions. In our experience, once they've had one, they're significantly more likely to need another. Keep in mind, with an eviction, this isn't just somebody who didn't pay their rent. It's somebody who didn't pay their rent and refused to leave until the court kind of oofed them out on their own, right? So keep that in mind. We look for a credit score of 600 plus, ideally, no felonies or misdemeanors. We're a little bit more flexible if it's something like they got caught with weed, no politics or anything. I don't really want to get into that, but it's less of a serious issue for us than something like, theft or vandalism or something like that. And then on top of that, we are wanting to make sure they make 2.5 to 3 times the rent. And that's kind of like their gross pre-tax. Guys, we want to set people up for success. I'm not trying to lease somebody a house that they really can't afford. And, there are times that we do have to decline for that or suggest they check out one of our other properties because, ultimately we want to make sure that renting and working with us is a win-win. And if we set somebody up where it's 70% of their income is going to rent, that's not going to be a good long-term fit for us, for them, or for that particular property. And then the other thing we're doing is we're always verifying the income, right? Calling and speaking with an employer. And we're also always verifying previous rental history. A really good question that you want to ask there is, would you rent to them again? are they eligible to re-rent, right? If somebody doesn't give us any rental history, we are very, I would say 99% of the time, we're not even considering them as an applicant, unless like maybe this is their first apartment, in which case we would still want a parent or somebody else to co-sign just to give us a little bit more security. That's just kind of a quick and dirty overview of the third letter in the Brrrr method, the rent piece. Coming up next, we have yet another R, which stands for refinancing. Now, I really have struggled with the Brrrr method in the past because there's so many stinking R's, but it's buy, rehab, rent, refinance, where we're hanging out now, and then lastly, repeat, turning the cycle all over again. So refinancing these types of properties is a little bit different. So this isn't a property that you're putting like 25% down on. Typically, your purchase and rehab are either being paid for with cash, doesn't have to be your money, could be somebody else's money, a line of credit, or something like private or hard money, right? So you are either taking a loan or you're in a position where you can dump out your own cash. All of mine have actually been funded with other people's money that we've been able to cycle. So we're not getting stuck with having to put out our cash or being limited in our ability to grow by what we personally have to go and purchase. Now, this is something you want to be careful with, right? You want to make sure you don't over leverage, you don't overextend yourself. And this is kind of the linchpin to the whole process. This is the proving ground of, did you get a good enough deal? Did you accurately manage and estimate your repair costs? Did you get a tenant in there where this property is now going to cash flow? And lastly, is a bank going to agree with you on all of those things? So in the Brrrr method, you're looking to refinance the property using a cash out refinance, meaning they're giving you money back at kind of the tail end of this process. So this is not like a Chase Bank or a Bank of America. This typically isn't a credit union product. This is going to be a local, regional, kind of like community bank. Now, one thing with this is kind of a goofy product. Cash out refinances historically are commercial. So you're looking for a bank that's willing to offer a commercial property on a residential asset. Now, this typically means this is what they call a portfolio loan or debt they're going to keep in-house on the books. It's not something they're able to then turn around and sell on the secondary market. So this is a pretty unique product, and it's going to take a little bit of digging for you to find somebody that's willing to do this. We went through a number of banks before we found ours. They always want what they call the relationship, which is basically they want your money sitting in a deposit account so they can, lend it out and make some interest on it. We had a bank we banked with for 8 or 9 months, had well over 6 figures in our accounts with them. And when it came time for them to finally pay the piper, their side of the relationship, they did not want to give us a cash out refinance. So a cash out refinance is going to be based off of the appraised value, meaning what an appraiser thinks the property's worth, not what you're into it for. It's a very important distinction. There's really not a bank out there that won't say, hey, you got an incredible deal, we'll give you 75% of what you're into it for, so they've got like a 50% loan to value. That's not what we're looking for. So for like quick and dirty math, on a $100,000 house, these banks are typically going to loan 75 to 80%. So you're looking at 75 to 80 grand. Now, ideally, let's say you got a really good deal, you managed everything great, and you're able to get a 75% cash out refinance, but you're only into the deal for 70 grand. Guess what? That 5,000 you get back is part of your mortgage, but that is cash that you get back that's technically tax-free because it's not income, it's technically debt. Now, this isn't necessarily something Dave Ramsey would agree with, but it is cash flowing debt that's being paid for by somebody else. That's where you kind of hear the argument of good debt versus bad debt, which is a whole nother topic. One thing to note on the refinances, some banks are going to want 6 to 12 months of what they call seasoning, just meaning that you've owned the property for that long. So that is something to be aware of when you start a project. if you get, say, only 6 months on a loan from a hard money lender or a private money lender, if your bank is going to make you wait a year, you've got a problem. So be cognizant of that up front, be talking to banks and figure out what they're looking for. Hey, what is your seasoning period like? We have banks that they don't have a seasoning period. We have banks that won't just do 75%, they'll go up to 80%. This is really going to be kind of regional dependent and specific. Some markets that are more expensive, like on the West Coast, they don't have any seasoning at all. Other markets I've heard of can be as much as 2 years. Now, if somebody's telling you more than 6 to 12, chances are you want to find a different bank. You don't want to wait a couple years. Another kind of option here, there are institutional lenders like a Lima One, a Finance America, something like that. Corvest is another. These guys are typically working just with investors like you and I, but the problem is they're charging a higher interest rate. So at a local community bank here in 2020, we're getting about 5.25 to 5.25% interest rate on a 20-year ARM. A lot of these kind of institutional lenders are going to be 7.5, 8% on a 30-year amortization, but you end up paying a lot more in interest. Your payment is typically going to be about the same or maybe a little bit lower, but you're going to end up paying a lot more money for it. And we're always truly looking to have the lowest cost of funds, which is why we're always going after kind of those local community banks. The last letter is the final R, which stands for repeat. If you bought right, you managed your rehab, you got it rented and you're cash flowing and you're able to refinance out your cash, you're now able to repeat the entire process with that same initial chunk of funds. We're also going to talk about how we're getting such good deals. I think that's one of the most important parts of real estate investing. Doesn't matter if you can manage the construction, if you've got the cash lined up, if you've got a bank lined up, if you can't find a deal that makes sense. So we're going to dive into that quite a bit in this channel. If you found this video helpful, please be sure to subscribe. If you're a new subscriber, please comment below where you're from. I just love to know where you're at. Happy to go back and forth with you a little bit and give you some pointers. Plus, who knows, chances are I know somebody in your market that I can put you in touch with. Thanks for checking out the video. Talk to you soon.